Hello everybody, hope that you are doing very well this evening and welcome to tonight's Contenders live stream. Well, I'm really simply going to be starting with BNB, Binance Coin Chart of the Week, and then I want to be moving on to CVD, Cumulative Volume Delta, and how I use this within my trading arsenal. This is one of, a key feature we've been building up to it. And I know many of you are very excited for tonight's live stream. So, that's what we're going to be going over tonight. I hope that you are all very well. And we can get into it. Let me just make sure. I'm not sure how well this webcam setup looks. I bought some new lighting, but it's made me look really white. I'm not sure, but nevertheless, it should hopefully improve the quality of the cam. Not that really makes much difference, but let's go on to this then. So just as always, start with this disclaimer. No financial advice. Everything that I'm doing tonight is educational purposes only, as you all know. So obviously if you're in the champions group, you'll know, I want to just start with this, you'll know, if you're in the champions group, which I know the majority here are, that I've made a post. I done a spontaneous live stream in the week. I think it was maybe on Thursday. I think the live stream that I done was, I can't remember exactly when it was now, but I done a live stream earlier last week, and I was saying to everybody, I don't see the need actually to have such a focus on altcoins at the moment. And this was the exact, I spoke about it in the live stream. I can't even remember what live stream it was now, but then it must have been probably on the 24th, I suppose. And then after that live stream finished, I expanded a little bit on my thoughts here, and basically I just said to everybody, give yourselves a challenge, okay? So it's not really a hard challenge, but try this, because I see a lot of people giving too much focus onto altcoins when really all you need is Bitcoin. All you need at the end of the day is Bitcoin, and people really get married to these altcoins, really, have really biases. The number one coin for this is probably XRP. That people are fully obsessed with XRP, and this coin has just been going down and 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 down. But they're married to these type of coins because I need to be looking at this in case it pumps. And the same is reoccurring with all the altcoins where if you spend this time just focusing on Bitcoin, because I think it's starting to come to light, isn't it? The more that I teach, the more that you actually realize, it's not as simple really as just putting a line on the chart and trading off it. There's so much depth to technical analysis, and again, it all comes down to a time at the end of the day. Okay, so obviously, if you have all day, then you could be looking at altcoins, but I don't believe the majority at the moment have all the time in the world. You have other jobs, etc., other commitments. So rather than spending you're dividing your time between altcoins and Bitcoins, because it's not easy to do a good technical analysis in 10 minutes. If you only have 1 hour a day, spend all your time looking at Bitcoin. That way you should find yourself doing better trades, in my opinion. So I was hesitant after saying all this whether to do an altcoin tonight. So I was really debating whether I actually add this in or not after telling everybody not to essentially trade altcoins for the next 2 weeks. I did add in an altcoin after saying this. I was hesitant. I probably should have left it out because this one's I've already been stopped out of this trade. So it was a really poor trade to get into. But yeah, I'm going to go over it nevertheless. But basically, I was looking for a long entry after basically we had got back above the weekly. What I was looking for, again, I was way too aggressive on this trade. I was actually looking for, I didn't think that we would perfectly hold it. So I was looking for a move down below the weekly and then get back above the weekly. That's where I should have entered when we come back below and above. But all I done really was I simply set my entry, stop loss and taper off, and I just left it alone. I came to it this morning and I hadn't quite hit my stop loss, but I closed it early. So yeah, I've already lost this trade, by the way. So I'm going to cover it anyway because it should be educational. At the end of the day, it's good to see me losing a trade, I suppose, see how I managed it. So this is what it looks like on the weekly. So essentially my setup was wanting to see this weekly essentially be claimed, and as you know, I was looking at BNB in this sort of range where we go from the lows to the highs to the lows, up to the highs to the lows. Obviously didn't quite make it up to this high, which should have been a red flag for myself, but nevertheless we made it back down to this low where we took out the overall low here. So we took out the low by literally only a few sats, but we swing forward that low. Okay, and I did take an original trade off of this anyway, so I wasn't an original long from this, but then we obviously back test a weekly. Okay, and it kind of got a rejection, but over the end of the last few days it managed to get back above it, and I'll zoom down timeframes in a second. And I got way too aggressive on it, because as you can see here on, this is the 4-hour chart, how it was looking decent at first. Okay, we got back above, come back down, and actually my entry, I was not filled on any of this movement. Okay, so it was really funny that my entry was like here. My entry was like here. I'll tell you the exact price in a second. And it was like coming down and it moved away, coming down, and it was like not coming into my entry. And then like as soon as it moved down, I got filled, and then just like I just closed the trade like instantly. The actual price I was trying to enter 18241. And these lows were not quite hitting my entry, so it was just like the whole trade was just really, really, really poor decision. What should have I done? So what I done was have my orders preset waiting, like really, really unusual for me for this. But I had the orders preset. While we were up here, I wanted to see this basically hit my order, get back above, reclaim, go on. Okay, all we done actually was, well, we came down. I didn't fill my long order. Price come back up. Okay, we then come back down once more, and then obviously this is now a lower high and a lower low. So we've locally changed the market structure bearish. At this point, I should have been cancelling my order. Let's be honest, I should have cancelled my order, but I left it in the books. Price continued to go on again sideways here. Clearly that my plan or my thesis was that we would hold this and then reclaim the weekly, and obviously that's not happened. It's a really poor trade to stay in, if I'm not totally honest with you. But nevertheless, I didn't stay in the trade, but kept my orders there, and we just moved sideways a little bit more, and then instantly we got that move down, come back up, and then as I saw this morning, I literally had the alert that I was in the trade. I looked and I was like in like 1.2% loss. I just closed it straight away, and I was just like, that was a really, really, really poor trade. So instead of spending any more time on it, holding it to stop loss, I just closed it for about 1.3% loss within a minute. So it was a really, really, really poor trade, let's be honest. But I wrote a little bit of a thing about it here. Overall, can I say I'm overall happy with the trade, although I was stopped? I mean, I was trading for a thesis that we would essentially, this was what it was looking like originally, that we would go down below the weekly. So my thought process was we would go down below the weekly, reclaim the weekly, and then move up. How was I really wrong by trading this then? Essentially I was wrong here because we lost the weekly as I was expecting, but then we didn't come back above it and reclaim. All we done was we lost the level. Rejection, move back down. So it was really, so my entry was too aggressive, wasn't it? Really, I should not have had the bids waiting. I should have had an alert where I had my bids. Obviously, if that was the case, I would not have entered because my entry was in an instant loss. I would have actually had an alert set and then maybe another alert set once we had tried to reclaim the weekly, but that didn't happen. And I like it when we look at it like this. Okay, either on any time frame that we're looking at, it looks really obvious and clean on the weekly, I think, or this, where we're just looking at the closes here. Really simply that weekly close, lost, back tested as resistance, moved back down. Overall, I'm not overly, I'm not going to lose any sleep about this trade, but it was, I can just say that I think my idea was okay. I think the setup was valid per se. But it was just one of those things, a little bit unfortunate, I suppose, with the fat Bitcoin obviously moving up very strongly today. So we had that very strong move up on Bitcoin. As we all know, altcoins do not like Bitcoin volatility, so it was only natural per se that with that extreme in brackets, that strong move up on Bitcoin, that negatively affected the altcoins, and as Bitcoin moved up, all the alts moved down. So I was in a Bitcoin long, so I made more money. I always trade higher capital in Bitcoin than alts, but nevertheless, poor trade in my opinion. Too aggressive on the entry. But the positives of taking this loss, I suppose, is that I knew where my invalidation was. As before you enter every single trade, you got to be knowing where your invalidations are. I knew where my invalidation was. I knew what I was after. And upon seeing my entry and instantly seeing that it had moved down, totally poor entry, if I'm totally honest with you. But nevertheless, I took that about 1.3% loss and just closed out, moved on. Not going to lose it. Not going to beat myself up about it. Just one of those things, I suppose. So yeah, that was chart of the week. I really should have took my own advice of trying not to trade altcoins, but I guess this is more for you guys. I'm still trading alts, but nevertheless, it was kind of just that this post was made for advice so to speak, for you guys that don't have as much time, I suppose. But yeah, so a little bit of a bad start with chart of the week this week because it was an instant loss. But yeah, that was the setup that I had on this coin, but just clearly failed. So I guess what could I be looking for next? Okay, what I could be looking for next, quite simply, actually price to let's just change this back to the candlesticks a second. Okay, what could I be looking for next? Well, to be honest, it's not the end of the world. Price still could make its way back up here. Okay, so I guess what I'd be looking for again is this was the kind of a flush that I'd in some ways should have been waiting for. I should have been waiting for maybe this flush to the downside. So if it can reclaim the weekly again, then that for me would be another entry. I would try and trade it again off of a reclaim of the weekly, and with the exact same sort of setup targets in mind. I was looking at the point of control of this structure as a target, basically. Okay, possibly up to that weekly, but if we're looking at this as putting in a lower high, if we're looking at this as putting in a high, lower high, might just put in a lower high. So that's why I was looking at only potentially this before it falls back down once more. Obviously, I wouldn't just say it's going to fall down there, but obviously we could get that potential move rotation back up to the top of the weekly. But overall, we are in a bit more bearish market structure here on BNB, and it does also remind me of the Bitcoin chart pretty much. I think back to 2018. I don't know, it kind of reminds me of this style. 2017, really big move up, hitting 20k, big drop, coming up and rejecting 17k, dropping down to 6k, getting this sort of we could call it redistribution pattern before moving back down once more. I don't know. I that's what it kind of looks to me like. So I'm not overly keen on this on a medium term perspective. I feel it will get another drop, but nevertheless, there's still a trade there. I don't short BNB, so I wouldn't try and short this coin just because I don't short it. But I would be, looking for a long, once again, a reclaim of the weekly. I'd look for that long, just up to the point of control of this structure, and then see how it goes from there. Maybe it claims the point of control. We can look up to the weekly, and so on. But if it rejects there again, or it just rejects here again, because obviously when we look at it on that weekly view here, all it has done was weekly support lost, back tested. So if this is the case and it just moves down from here, then yeah, I'd be looking for that monthly, to the weekly possibly. So those are the key levels of interest for me. But yeah, I don't short this coin, so the only thing I can look for is longs, and that next one long for me would be another reclaim of that weekly, looking up to the point of control of this structure there, to see whether we claim that level. If we do, we can look back up to those higher two weeklies. If we reject, then yeah, I'd close out the long for profits, obviously, and then just buy my time waiting for the lower prices to come. So that's the BNB setup that I had for you there, or chart of the week. Obviously, yeah, wanted to cover it even though it was a losing trade, but that was the theory behind the trade, why I took it, why I got out, and why I still believe it does have potential for another long. It could be tomorrow, for example. But I'm going to buy my time on it rather than buying it right now. I'll buy it on a bit of strength. So yeah, that's BNB. So let me just take a drink and we will start. So, CVD, cumulative volume delta. I know this is the one you guys have been wanting for a while. So let's go. So CVD, it stands for cumulative volume delta, and so it is the running total of delta. Okay, so cumulative volume delta, it's the running total of delta. So for example, here we start. So just so you first are aware of the calculations of what we're actually looking at here. As you know from last week's stream, it's kind of a prerequisite that you watch the last few streams before you move on to this naturally. So our delta, what we've been going over on the last few streams, was just like for example here, let's say we're on a 1 hour chart. So every 1 hour we have a new candle printed with a new, obviously the volume, overall volume, and then the delta within that candle, and then the cumulative volume delta is essentially adding and subtracting the deltas to give us a running total of what that cumulative volume delta is. Okay, so in this example we obviously have, let's just say we have on this candle 12 million. Okay, and then the following candle, let's say this is a 1 hour candle to keep it very simple. Our following 1 hour candle included, obviously 309 million with 57 million positive delta. So we take 12 million, okay, of our previous delta, add 57 million, and then that gives us a cumulative volume delta of 69 million. Okay, so moving on, we'd take 69 million, and here we get a negative 7.8 million delta. Okay, and this is trade exo charts is going to round it up slightly, so it's not going to be like the exact numbers, but it's not going to really matter so much 200,000 contracts. So here we obviously have 57, then we have 69 million minus 7.8 million. Rounded here, it's giving us a total of 61 million. Okay, 61 million minus 838,000 contracts is obviously giving us 60 million, more or less. 60 million plus the delta of the following candle, which is 3.7 million. Again, it's rounded it here, but 64 million. Okay, so you can see how this is, really clearly being worked out. You take the delta of each candle as it's coming along here, and then the cumulative volume delta is simply adding or subtracting that delta, and to give you a running total of that overall delta. Okay, so that's simply how it's calculated. Okay, I will just mention this a second, that on exo charts, okay, so this is going to be the same on other systems platforms as well. You can obviously, if you have my template, I've set it all up for you already, but basically you can come across to here and go into CVD, and I like to look at it on full data. That you can also change this to session. So what this is going to do, okay, so then at every session, which is daily close, so when you get a daily close, you can see how from yesterday, okay, I might need to zoom in on this. You can see from yesterday you got to negative 138 million, and then as you start a new session, which is a new day, then it resets and it goes to 5.5 million delta. Okay, so you just see the difference. Full data is not going to reset essentially to 0 at the start of a new day, and session is going to reset at the start of every day. I personally never use session. I guess I can't say never, but I very, 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 very rarely would go to session. Okay, I'm not so interested in the session. Okay, I do like to look at full data though. Okay, so full data for me is the most helpful. That's where I'm looking for my divergences. But just so you know what the difference is, really, I'm mentioning this because I don't really use it. But you might be interested in just at least what the difference is. On other platforms as well, you will also have visible range. So that just means whatever you have on the screen, okay, it's going to be calculating the CVD of whatever, the visible range, simply what you have on your screen. And that I do find useful sometimes. I don't have that option here on Exo Charts. Okay, actually you do. Yeah, you do have visible range. Okay, sorry. On here you do also have visible range. So visible range or full data are the two that I would primarily be using. Okay, those for me are absolutely fine, but session I never use, so I'm not interested in session. But visible range and full data, they're actually both absolutely fine. You can be using it, and naturally, as you can see here, visible range is taking this off really simply what we have visible. Okay, so those are the two main ones that you want to be using. Okay, full data is the best in my opinion. Then visible range is absolutely acceptable. There's not going to be too much difference, and one I wouldn't ever use is session. I'm not interested in that. Okay, so that's to begin explaining to you what those three are. Okay, so CVD, very simple, is adding and removing delta together. Okay, so I like to look at delta alone as per last week's live stream, so I'm not always just like looking at CVD. I will take into just the delta itself into consideration, and also CVD delta to look at divergences in price. So this is what the focus of today is going to be primarily, of how we identify divergences, like really what divergences are, because we cannot just say that this is the same as like RSI divergences, etc. CVD divergences are really, really, really powerful because we can see where the bigger traders are. Okay, so CVD. So as I'm just going to take a really quick drink. Excuse me. So as moving on from last week, I touched upon this as well. So passive orders are obviously limit orders. Okay, so passive orders at limit provide liquidity to the market. Again, on certain exchanges, BitMEX, Bybit, etc., you get paid for providing liquidity to the market. Okay, so as like a quote unquote market maker, if you are providing liquidity to that exchange, they're actually going to pay you. Just a little bit off topic, I suppose, but many people are always asking me, Daniel, if you are only trading for a 0.02% scalp, let's say, or a 0.2% scalp trade, I'm literally going for like a 10, let's say $10, $15 move on Bitcoin. How am I making any money? Because the fees are going to take all the profit. Well, what I do is I trade on exchanges which offer rebates. So basically, they pay me for entering a limit order. When I enter a limit, I could literally, for an example, enter a short 9,001, close that short 9,000, that's a $1 move. You might think that's nothing, you cannot make any money. But if you've got the limit orders there that are, let's say 500,000, from a $1 move, you're going to be actually paid $100, let's say offhand. I'm not sure, can't remember the exact calculation, but it's about 0.2 offhand percent, depending on your exchange you're on, obviously. But obviously, if you're providing pretty large liquidity to the market for a $1 move, you're getting paid for it. So so for another example that I've done before is let's say that I short 9,001, and then I close that short for a loss at limit at 9,005. So obviously that is a loss in the trade. I've shorted $9,001 and I've closed the trade out at, I've entered at limit and I've closed out at limit at $9,005, for example. That is obviously a $4 loss essentially, because prices moved up $4 when I'm in a short. But because of the fees that you get paid from limit orders, you actually gain money. So, this is something to just bear in mind, okay? Just to bear in mind that you can even take a losing trade, and if it's smaller than the rebate, then you actually get paid even when you lose. So you can kind of see the advantages of using limit orders, I suppose. Whereas market orders are very, very expensive. Obviously, there's a time and place for market orders. Let's not forget that. There are times where I'll happily enter at market, and there are times when that's needed, and obviously that's needed at times, but generally speaking, we want to enter at limit. So limit orders are generally used by bigger traders for this exact reason. You don't want to be throwing away, if you're entering a few £1 million orders, you could be, we're talking, you could literally throw away in fees instantly, like $5,000. So it's obviously quite a lot. $5,000, if you're throwing away $5,000 on every single trade, it's going to add up over time, isn't it? Whereas if you get in at limit order, and instead of paying $5,000 for the market order, you're receiving, let's say, $500 in free money, then naturally you're going to be going towards limit orders, aren't you? But yeah, that's what I just wanted to touch on there. But today I'm going to be covering CVD divergences, which are very powerful, as we can see where the bigger money is trading. And as taking the thesis essentially that bigger money is entering with limit orders, we want to see where that bigger money is essentially trying to absorb everybody's orders and move the market, okay? Market makers for a reason. We want to see divergences build up over a period of time. I go into this more depth as we get to the slides, but basically this is another thing that I just want to touch here, that we want to see divergences build up over a period of time rather than one candle drop / wick / stop run that forms a divergence, okay? Also, as CVD is calculated using the whole candle, okay, we look at divergences using the whole candle naturally, okay? So it's a little bit, obviously RSI is calculated from the close. So you never is the wrong word because people can do it, but the calculation for RSI is obviously from the candle close, and then you look at it over a period of time. But that, RSI divergences, you have to go from the close because it's officially calculated from the close, whereas CVD is obviously calculated using the delta of the whole candle. So naturally you can be looking at wicks because the data is being taken from the calculation of that whole candle. Why I mention this together is although it's taken from the whole candle and you include wicks, I'm not interested in a CVD divergence, which is one wick to the downside and straight back up, and then you have a divergence form. That doesn't interest me. I want to see a build up of divergence over time rather than one quick wick. Just something that wouldn't interest me. So and I've got a slide for this coming up in a second just to fully explain that as well. Okay, so this is essentially what we are looking at. So this is an example of bullish CVD divergences, and the concept is not overly hard. I'm not going to sit here and say this is difficult to understand it. You should hopefully all fully understand this by the end of the live stream. It's not too difficult to theory, but just a key bit of knowledge that not many people know about. So what is bullish CVD divergences and how are they forming? What's the reasonings that they're forming? Very simply, let's imagine this. We have a move to the downside. Okay, so this is the Bitcoin chart. We have a move to the downside, and then you go sideways for a period before another attempt at a move down. And let's just say this is the daily chart. So we have a move down, range, before another attempt at the lows. We can see that price forms a higher low. So from this low to this low, we've made a higher low, haven't we? But the CVD, which is obviously calculating our delta over time, has made a lower low. So what is this telling us? This is telling us that over this period of time, from this low to this low, which is obviously a higher low, we have made a lower low in delta, the CVD, which is showing us that there are more people market shorting over this period than there were here. But if price is making a higher low and more people have market shorted, that is showing us that a bigger trader is sat here with a limit order absorbing all of these market sells. Does that make sense to you? Okay, this is essentially the knowledge that's how it's, that's what we're looking for here. We are looking for the bigger trader. We want to see evidence of where is the bigger trader trading from. We could say, big market makers, they're not interested in trading 1 minute time frames. Let's say that they're interested in these bigger term, bigger moves. And so if they can hold up price from a big level and we can see evidence that they're participating at these big time frame levels, then naturally we would only want to essentially follow the footsteps. Okay, you wouldn't see this generally speaking and think, I'll market short here as well. You generally want to go to bigger hands, don't you? So we can see here, this is, really simply, again, CVD and Delta. Remember, this is only showing us market orders. So in this candle, there was 57 million negative Delta, and that was 57 million market shorts, okay, essentially over that candle. So this is only showing us, the Delta is only showing us market orders. Okay, remember that. But what we can see here is because you make a higher low in price, but a lower low in the CVD, we've seen more market shorts come in here. So more people are entering shorts at market, but because, that would be normal if you break the low, but because you make a higher low, that is showing us that somebody, a larger trader, whoever it may be, or it doesn't have to just be one trader, obviously it could be many traders, holding this up with limit orders. And if they have the capital to hold this up with limit orders, well, naturally they are doing this for a reason, one would think, to push price back up higher. So this is an example of bullish CVD divergences and why it's formed. Okay, so again, another example over on Sierra charts. Our low formed here. We then go sideways for a range. You form a much higher low. You see how this is low, higher low, higher low, higher low. But the CVD is just continuously going low, lower low, lower low, lower low. So it's a massive divergence, isn't it? And this is on a high term time frame. Massive divergences between price and CVD. So what is this again? Once it's just showing us price is making higher lows. People are essentially, we can just say this, people are entering very strong at market shorts, market shorting. They're going very aggressive at market shorts while price is uptrending. That's showing us that the majority are shorting. But if price is not breaking down, there is somebody or bigger capital, a series of traders holding up price, and we want to be trading with the bigger hand. Okay, this is obviously going to work again in the stock market. Or for example, you have billions trading every day. You don't want to go against the Fed, let's say, for example, with their billions. You want to trade with the bigger hand. You'd be silly to trade against them, wouldn't you? So, this is what we're looking at here, essentially. This is showing us aggressive market shorting. But if price is not breaking down with all this aggressive shorting, well, then what's this highlighting to us? Somebody's holding up price. Those aggressive shorts are likely to be squeezed, and we would see a move to the upside. Okay, so again, bearish divergence is the exact same sort of viewpoint where prices would be making then here a lower high. So price clearly makes a lower high, but we can see here on the CVD breaking upwards and upwards, okay, where these are clearly lower highs here, lower high and a lower high up against the point that we're looking at. But the CVD is going up and up, okay, from our reference points. So what's this showing us? That people are aggressively market buying here. People are really aggressive market buying, let's say. But if price is unable to take the high, while we're seeing a lot of aggressive market buying, again, somebody is sat there with a limit order absorbing all of those market buys, naturally expecting lower prices. If we can identify where somebody sat with a limit order, and we generally are going to just say, to keep it simple, that the limit orders are from the bigger traders, then we want to be trading with them rather than against them, generally speaking. Okay, and this is obviously our bearish CVD divergence with a lower high in the price and a higher high in the CVD line, showing us once again that people are aggressively market buying here while price is unable to break up. We have the the possibility of trapping all these shorts, trapping all these longs of people that are market buying expecting a breakout. When you break down, that's really the confirmation that we then can see that these are likely trap traders, and you would expect decent follow through. Okay, so another example here, this is one on Sierra charts, just so you can see the difference. So again, lower high on price, or you have point number one, point number two. This is a lovely example because we have a high, we then have a lower high and another lower high again. But you can see here how this high was a higher high from this high, and then once more you see another high after this point, which was an equal or lower high. But you're seeing several steps of it here. From this high to this high, you have bearish CVD divergences. And then from this high to this high, you have bearish CVD divergences from this high to this high. So these are equal highs. We're seeing a increase again in CVD. This is showing us then large term time frame CVD divergences and then local CVD divergences as well. This is not really something that we are going to be interested, so to speak, in long in, are we? We're going to be recognizing these signs. We have high time frame from a big reference point to a big reference point, bearish CVD divergences, and then locally as well we also have a high, an equal high, almost a double top, but the CVD has broken up again. So this is showing us large term time frame, bearish CVD. Locally we have double top with bearish CVD divergences. This is not something I would be, generally speaking, so interested in. Definitely not interested, so in longing if this is the only data I'd have. This is, if I had only this, I'd be saying got to be looking for the shorts. Okay, and then obviously we can see here how we break down from that. Okay, and this is the way that I would be looking at this. So I'll just highlight this for you a second. This is the way that I would be looking at this. We could take an aggressive entry up at this high. Okay, so we could take aggressive shorts up at this high. That's acceptable. Where's it really confirmed that this has been a CVD divergence? Was, well, locally, we can say really when we take these lows. So when we break down from this low, we might be thinking, okay, that's market structure changed. We're no longer making these higher lows. We've broke down through this support. Once that support has been broken here, you might be getting a bit more bearish. Obviously, you don't get a really nice retest and down because of this. You've got so much trapped longs. Essentially, you don't even get a retest of the level, and I'm referring to this level before down. You get a very, very, very weak reaction before down. You don't even retest this perfectly once again down, and the downtrend continues. So what can we say the confirmation is? Really, the confirmation is of a short, I would say, is when you break this market structure, so specifically these lows around here. And then you could be looking, because then it's really confirmed that this was a bearish divergence, and you got all these trap traders, and you would expect that downtrend. Okay, so that's what I'll be looking at there. Okay, so moving on. CVD. Quick wick divergences, and I had to reference this because obviously over the last week a lot of people have been posting about these divergences, and one thing that I've noticed is that there's a lot of people posting about these. I didn't know I have an official word for it, so I've just called it a quick wick divergence. But this is not something I would ever be interested in trading. I would never take this into consideration. Okay, it's not enough to base a trade off of. I want to see absorption over a period of time rather than just one wick to the downside straight back up. Okay. So as I've mentioned here, I'm not a fan of divergences such as that on the left here, where you get a really quick wick into the level, which forms a divergence. Okay, what I like to see is divergences over several candles, which shows absorption. So why don't I like this? Let me explain. We obviously have a move down, move back up, and let's say this is, I don't know, a 1 minute chart. Then we have a move down, and it could be even more V-shaped than this. I guess this isn't a perfect example, but let's say that this was in fact for the purpose of learning, it was a really V-shaped recovery, or it was just literally we had this candle and this was okay, and the divergence formed after this candle here, let's say, formed a really long lower wick, and then price continued up. Okay, but after this long lower wick, so we're ignoring this, pretending it didn't happen for this example, we form a long lower wick and then back up, and it formed a lower low on the CVD, and all it was a long lower wick. That's, for me, I'm not interested in trading that. I wouldn't say, oh look, we have bullish CVD divergences, let's take a look. I want to see it more on this example on the right. Okay, so this example on the right is just lovely because we do have this sort of rounded, you see, it's like a rounded bottom. It's showing us that over time we can clearly acknowledge this is making lows. So bigger term time frame, we have bullish CVD divergences. Okay, and then locally here you also then have them again, don't you? So from this low to this low, so from this low to this low, this is a higher low, but even locally price made a lower low on the CVD line here. So this is showing us locally there's bullish divergences, and then on a bigger term time frame we also have from this low to this low, bullish divergences. So when we see these high term time frame and locals like lining up together, it just gives you even more strength. You don't need this per se, but it just adds into the idea that what are we seeing here? We're seeing people really aggressively shorting all of this move. Okay, so if really from where it began to all the coming periods, people are aggressively shorting, really aggressively shorting, and then it really stands out to me here as we get this kind of rounded bottom, and the CVD is continuing to break down while price is not breaking down from this point to this point. It's made a higher low, but people are clearly positioning themselves at market shorts that they're expecting this to break down further. So again, when does this really confirm? I would say in this example, okay, it really confirms. As you can see, this is where we can imagine that there's trap shorts down in this region. Down in this region you got trap shorts, and again, just because it's a wick, that the majority of the volume can be in the wick. Again, that's where you go to a footprint chart and zoom in on the candlestick to see where the volume is, because as you know, the volume doesn't have to be in the close. The volume can literally be right at the bottom of the candlestick. And so where does it really confirm? I would say then once you really break this structure, you break above. Okay, well this is then clearly showing to me as soon as you get this candle above, all these traders down here are trapped already, aren't they? So we saw the aggressive, we saw them aggressively shorting. As soon as you really take that high and change this market structure to what's going in like a downtrend, you take the highs that have led you off to this local divergences. As soon as you take that high, that for me is what I would say is confirmation that we have got this actually confirmed divergence, and we've now broken up. You would be looking to potentially long the next retrace, or getting in at market as you break these highs, expecting these lower shorts to be trapped traders, and expect that reversal. So yeah, that's the difference there. The quick wicks, which I would never trade off of. I'm not interested in just a quick wick straight back up, and if it forms a divergence, it forms a divergence, but I'm not interested in trading off of that. I am interested in trading these sort of like build-ups. So again, this is just showing me absorption. So if I'm seeing a period, okay, again, this can be on low term time frames, but if I'm seeing a period of CVD divergences where I'm seeing, for example, in this example, people aggressively shorting, but over that same period of time, we're not breaking the lows. And I know for a fact that there's somebody sat there with a limit order absorbing all of these market sells. And if I tend to say to myself, the bigger hand here, the market maker is holding price up, he's generally going to be expecting then higher prices, and we can then trade with that and trade at higher prices. You know what I mean? So that's quick wick. What I wouldn't want to see, what I would want to see. Okay, so I hope that makes sense. Again, if you have any questions, ask me at the end. So I've been hinting upon this, like confirmation of CVD. Okay, so cumulative volume delta and the divergences that you get from this has two steps. Okay, so there's two steps within this. Okay, the possible divergences forming. Okay, so this would be like this, for example. This just like this. This is a possible CVD divergence at this point. You're aggressive if you're buying here. Okay, if you're buying down here off of this CVD divergence, you're aggressively buying because you're expecting this to not break down, aren't you? You're expecting it to get the reaction that you're waiting for. So the possible CVD divergence, and I'm generally trading the possible ones. I generally don't wait so much for confirmation. Again, I'm not just trading off of this though, but if I see these possible divergences where I'm expecting a bounce from other technical analysis, well, it just lines up into a really strong idea, and I'd happily buy it. But really, this is still only a possibility at this point. The confirmed divergence is when price actually starts to move away after having formed those divergences. So if you go to a chart, let's say you load up a chart and you see divergences, but price is still aggressively tapping these highs, and you might say, oh, we got bearish CVD divergences, I'm going to short. But then price just continues up anyway. That can happen. So obviously the confirmed divergences, when you log onto the chart, you see those bearish CVD divergences, but then you actually start to break down, change the market structure. Well, then that then can show you, right, you have trap traders at the highs. What I would be looking for, okay, so if I wanted to see if we had then trap traders, like how much trap traders do we have? Are we talking about like nothing, or are we talking about a decent amount of volume? Okay, to see that really simply, we can come over to here, for example, and type in something like delta, okay, and have that on our candlesticks, and then be like looking here, for example, like can we say that there's a lot of trap traders? This is what the example yesterday, I suppose, is probably a better example when so we came up to the highs here, And obviously, when we came up to those highs, I think we did, I'm pretty sure, yes. So there you go. Let's just expand this. So this is yesterday. Okay, so this is yesterday. So yesterday, what we had was a lower high, and here we had this slight higher highs. So this is CVD divergences. Somebody was sat there with a limit order, absorbing all of these market buys. So we can see in this candle specifically 30 million market buys. Okay, so we're seeing a lot of people aggressively buying. Okay, and then what can we do to really say, okay, how much aggressive buying do we have going on here? What we can do is sort of zoom in, and we can, see to ourselves, okay, so at these highs, we're seeing, 1 million, 1 million, 2 million, 1 million, 1 million, 1 million, 2 million, 2 million, 4 million, 3 million, 2 million, 2 million, 2 million, 2 million. Obviously a little bit of negative here, and then a little bit of rotations, 2 million, 2 million. Just a decent amount of volume, isn't it? There's, across these candles, okay. And then obviously, if we're referring back to the range, you're seeing a decent amount of volume that's built up into these highs. People obviously buying here, especially at this high. People are buying here, expecting a breakout. These are breakout traders. So then, really, as we then move back down through that level, what's clearly showing us divergence, this is confirming as we break down. It's really confirmed it, but that's what we had yesterday going on. But I just want to finish this before I'll load up that again in a second. So sometimes you will see instances though. So this is why we sometimes, or one might want to wait for confirmation, because sometimes you will see instances of delta leading price. So it will look like CVD divergences are forming only for price to then essentially follow and then break through the highs. So if you're looking at this as an example, you can see here you have bearish CVD divergences, lower high on price, higher high on CVD, but then you will see instances where it's looking like bearish CVD divergences and then price just continues up, and you'll be like, wait, there was bearish CVD divergences, how has price broke up? Well, obviously, firstly, nothing's 100%. But secondly, the context is massively important when you're trading divergences in general. Okay, so it will look like CVD divergences are forming only for price to then follow. Context of the trade and monitoring delta, volume, the time taken of the rotations, and this is what I'll be covering in the coming weeks, that we're not always looking at time frames. Okay, so for example, when I'm looking at rotations, I wouldn't always just be like on a 1 hour chart. For example, I might come over to like a 5 million chart, and then I can really see over like a 5 million candle, like how long are we actually taking these rotations from high to low. So it's not always, that's just something that I'd be looking at, like how long are the rotations taking, the time taken, the delta and the volume that you're going into each of those rotations, and obviously other technical confluences. You don't, just because I'm teaching you about volume, it's not like we're forgetting everything else and only focusing on volume. We are having an arsenal of trading, trading tools, so we are referring to them all here. And what we're doing is we're building up a case, and it's very important with divergences to look at the context. So all of this, as well as the context of how we're approaching these levels, where it's coming from, where it's likely to go. Okay, so the context massively important. So it's not as simple every time we see divergences short/long. Okay, it does take time and experience trading to fully know which ones will likely play out and which ones are fake divergences. I just mean delta leading price. A little bit of a shout out here that my call rate on the CVD divergences in Chart Champions is 100%. When I've traded the CVD divergences and I've posted about it in the group, I've not lost a trade on this. So this highlights to you that it's definitely possible, because I have a 100% win rate on it, of knowing when delta is leading and likely to break out, and not to short those divergences, and actually seeing the divergences that are likely to play out and go with it. Okay, got a 100% win rate of calling the divergences that I'm trading in the group. So I know which ones are likely to play out and which ones are not so much. And this is primarily because I'm, pretty good at reading the scenarios, several scenarios and tools coming together, which obviously give very high odds in trading. Never renting off of just one technical tool. So I would never, ever just trade off of one thing on its own. It will take time and experience to recognize which ones to trade and which ones to believe delta is leading. So here I have a little bit of a sheet just to show you some examples of delta leading, and like how we can acknowledge and see this in the time. How could we know, essentially? So how could we know, yes or no, whether we're getting a divergence which we should be trading from, or whether we're likely seeing delta leading and price is actually likely to break up? Okay, it's not too difficult, I suppose. So here we have an example Where here, higher low, lower low on price. Really simply, we can see that this was bullish CVD divergences, which, yeah, they did play out, didn't they? Because we made a higher low on price, lower low on CVD. From this low to this low, we saw a lot of people on market shorting. Price obviously made a higher low from this situation, and it makes a rotation to the high. So we're looking at this as a range, low of the range, higher the range, or maybe higher the range here, and you get a little bit of a fake out before coming back down to the lows. Okay, this is actually, funny enough, the example from last week. So this was last week's example that I went through of when we were looking at Delta to determine whether we're actually likely to break up out of the range. And this is why, obviously, Delta and what we're going over tonight, the divergences behind the Delta, they're intertwined. You don't look at just one, you look at them both. Okay, so obviously in this example that we've got here, here you can see Delta leading price, where we see a big increase of market buying at the top of the range before taking the high, which is obviously bearish divergences. But then price catches up with Delta and shortly breaks upwards too. Waiting for confirmation of the breakdown before shorting is obviously one option, but being able to understand the context of what price is doing and when it went at the high and how it approached the level is key. Here, and this is obviously just what I was saying last week, so I'm not going to do it in too much detail because I went over this exact scenario last week. But basically here, you saw the lows defended and bought up with a strong positive Delta. So what I refer to is here, as we came down to the lows, this low was obviously bought up on high positive Delta. And if you're seeing people aggressively buying at the low of the range, that's obviously natural, but there was no interests in shorting for continuation. So this is a little bit of a heads up. So it's not the biggest heads up, but because that's generally what you'd expect in the range. But the lack of selling interest and the really big buying interest was very obvious on this rotation to the lows. Okay, and then obviously. So we saw the lows defended with strong positive Delta, which follows through during the rise with net longs increasing too. So then obviously as we're increasing here, we see the increase in Delta. So people are aggressively buying this up to get up to the highs, as well as net longs go across and just look at your net longs, net shorts. Open interest, we were seeing open interest increasing, net longs increasing. This is all coming together like people are aggressively buying this up, and we're likely to see a breakout of the range, aren't you? So if you don't want to just go against what the evidence is on the chart, really, do you? So, and then at the high, little selling interest and also strong positive Delta. The context of this trade was tell us it's more likely to break up. So what I mean here is then as you approach this high, what we could call this is consolidation under resistance. So we have a really clearly defined resistance, and then we start consolidating under resistance with really aggressive market buying. So this is obviously, in the time, you might have looked at this and said, this is bearish CVD divergence. And let's just see what you could have said. Okay, you could have said to yourself, from this high to this high, let me use this, from this high to this high, and from this high to this high, that's bearish CVD. This is a lower high, but here we made a higher high. So two things to acknowledge from this. The first thing we can acknowledge, okay, people are aggressively buying the middle of the range. Because if we were looking at this as range, low, range high, range low, midpoint of the range, people are aggressively buying the midpoint. First thing to acknowledge, here we do have bearish CVD divergences, and one could say is it played out because you did get a drop in price. You got a drop in price there, didn't you? So if you shorted aggressively off those CVD divergences, maybe you hit take profit one, stopped on the rest. Let's be honest, but you get a little reaction. But the thing to note here is aggressive buying at the lows. Nobody was interested in selling. Move to the midpoint where we continue to see people aggressively buying this up. Not any selling interest. Really, the important thing for me is high, higher, low, higher, high, higher, low, higher, high, higher, low. And then we obviously move on to a higher high, higher low, higher high, higher low. If price is building this bullish market structure is so crucial. It's so simple, but people just seem to forget it. Like, it's just so crucially simple. If you're seeing aggressive buying of the lows, nobody selling the low of the range, only seeing buying interest. The defense was really weak to get down to this point. Okay, the books were just thin. And then upon seeing a move down on thin books, you then see the lows aggressively bought, move up to the midpoint, aggressively bought. Again, with bullish market structure, there's not a single loss of structure in this. It's continuous, higher highs, higher lows. And then again, you get the bearish divergence, but it just forms another higher high, higher low. And then you start consolidating under resistance with again, high, higher low, high, higher low, high. If you're seeing higher lows into this flat resistance and you're seeing the delta really strong, you're seeing CVD breaking up. The CVD here is showing us, yes, it's showing us bearish divergence, but the context of this trade is crucially important to understand. Nobody's interested in selling the top of this range, are they? Everything is screaming at us. Everybody is, the market is aggressively buying this up. And it's just screaming to us, why try and short this level? It's telling us price wants to go higher. Okay, so we're simply auctioning. We're auctioning from the lows to the highs to the lows. But suddenly these lows are viewed as a massive discount in price. Remember that this discount in price came from a really big drop. So a really big drop in price, which was obviously too big of a drop. Let's say that we had let's say we had the new iPhone sells at $1,000. You had a really big drop in price for coronavirus issues, let's say, and the iPhone's suddenly auctioning at $300. Well, it's not going to spend long at $300 before people realize, when coronavirus ends, I can sell this again for $800. I'm going to buy it at $300 and I'll sell it at $800. And essentially that's what you get here, an auctioning process, quick move to the downside, people not interested in selling these lows, only people are, interested in buying these lows. You come back up to what was once an old high, but again, people are still only interested in buying this high. You see the bearish CVD divergences, but this is delta leading. This is showing us the context of this trade is bullish, and then you break on from the high, you kind of don't even manage to get a back test, again just showing you so much strength. So from this high you don't even come and back test it fully before breaking up again. Very, 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 very strong, and the context is crucially important, because if you were only looking at CVD divergences, well, you would have shorted this high, and you got little pullbacks, but nothing that broke market structure. So market structure is crucially important if you want the confirmation. And that said, I'm not always waiting for confirmation. I will take aggressive entries, but I'm very, very good at reading the context of trades. That's just truth. So yeah, as I was saying here, I can't remember if I read the bottom of this one. The reason here was initially, I don't think I read to the bottom of this, did I? I'm going to read it quickly just in case I didn't. The reason why there was initially bearish divergence is because limit orders were at the high of the range expecting a breakdown. No, I didn't read this. I can remember I didn't read this out, did I? So yeah, the reason why there was initially bearish divergences. So I'm referring to why we initially had bearish divergence from this high to this high, this high to this high. Okay, we initially had those bearish divergences because yes, there were limit orders selling at this price. Okay, so there were limit orders selling at those price, expecting a rotation back down, but with much more buying interest than what is normal at the highs of the range, and the context of why it approached that high. It's only a matter of time before the limit orders are filled and price moves upwards, thus squeezing those limit orders. So what we can say on this is there was definitely people sat at limit shorting, weren't there? Because we can see the divergences. There were definitely people shorting there, but what they failed to acknowledge is how we approach this level. Was this a good time to limit short? Well, obviously in hindsight we can say no, it wasn't, but in the time as well, I would say, there's no reason to try and short that high. People have attempted to do it, and essentially we can say they got caught off sides, and price moves up. But we know why those CVD divergences have formed, really. Okay, so as you can see, being able to understand the context in every single trade is important, as if you cannot, you will not understand why this tool sometimes works, sometimes it doesn't. Okay, so a few things that we're looking at is obviously context, very, very important, of how we're approaching the levels. And then what we can be looking at in terms of context, we can be looking at delta moves from the highs to the lows, the time and rotations. So the rotation from the high to the low is the last rotation, happening quicker. We can be looking at things, clearly other technical tools. Okay, we could be looking at the slope. Okay, so the slope of the increase, is it greater or normal than the average of the range? There's a lot of averages and statistics that you can be looking at in this range to determine essentially whether we're likely to break up, or essentially consolidate under resistance and break up, or whether we move up to the top of the range, get the divergences and expect the rotation to the downside. And again, this is aggressive. Okay, so obviously when we're looking at something like this, and let's say we see this up here, and the context is bearish, other technical tools are bearish, then we can enter aggressively at these highs. There's no reason not to short here, maybe have our stop loss above that original high, and short aggressively the highs, stop loss above the next high, and see price go down. You don't need to wait for confirmation. If you're a good trader, you don't need this confirmation. The reason why I'm mentioning this is because I believe maybe starting off you do want to wait for the confirmation until you get good at it, but it's up to you. There's obviously two ways to trade this, and so this is the confirmation that I would say, and it boils down to essentially market structure and delta. So from this high to this high, we have bearish CVD divergences, okay, equal highs / lower high with price breaking up massively. And again, this is a high term time frame bearish divergence from reference point to high. And then locally again, equal highs locally with again another step of bearish divergences. So we're seeing high time frame and low time frame coming together here to give us bearish divergence. Okay. So where's the confirmation? We could get aggressive short these high, stop loss above the high. Say you don't want to do that because you're not at that level yet. So what you could be doing is waiting for confirmation. And here, the confirmation is breaking market structure. So the low that led us up to that high, once that low that led you up to the high is broken, then we can say that this is a time to short. So as soon as we break down there, we could be looking to short the next retrace or market selling as soon as we break that low, because we've then broken local market structure, the low that brought you up to that high, we've broken through it. We might have a stop market set to short as soon as that level breaks, or alternatively, you might wait for that level to be broken, short to retest. However you might do this, obviously several ways that you can do this, but nevertheless, that's one form of confirmation, really simply the market structure, the low that led you up to the high. Obviously, again, this is a bigger form of confirmation. The overall low, let's say that this was a range, low of the range, high of the range, low of the range, high of the range. If we break the low of the range, well, then we might want to be saying to ourselves, okay, if we get a retest of this range, I'm going to short the retest of the range. Here we can see that we kind of do break down from that range, retest that range perfectly, sell off. Okay. And again, things that we'd be looking at this is we could also be looking at the delta. So obviously here we can acknowledge that it's more likely to fall down because of the trap traders that we have at the highs. And then we can be looking at how are we falling down here? Are people getting aggressive at the lows? Are people interested in buying at the lows? Are people still aggressively selling the lows? All things that we can be looking at, okay? So yeah, those are things that I'll be using for confirmation. Again, so if we're up at the highs here, and especially on the second peak here, we have little buying interest, and then the following candle, and let's say that this candle here is really big negative delta. Well, clearly, if we start to see really big negative delta come in on this candle, or even the candle that tries to break, and that candle is really negative delta, that's showing you bears are willing to sell these highs. There's a lot of people willing to sell these highs. That's at least not try and buy the breakout. And especially then if you get the bearish CVD divergences, and on the following candle you get like the really big bearish negative delta. Well, it's pretty. That's a quicker confirmation rather than waiting for the breakdown. Just go off of what's happening in the market, the data that you've got. That's a pretty good time to try and trade with that market and expect the rotation to the low. So again, you can be getting a quicker confirmation by looking at things just like delta in the real time. So the CVD divergences are formed once we have broken down from the high in this example. This example, so once we've broken down from the high, that's when they're confirmed, aren't they? When price changes market structure or moves down from the high on an increase in negative delta, to show bears have taken control locally after trapping the longs at the high. That is your confirmation. CVD divergences can be traded on any time frame. The higher the time frame, they are visible / stronger. They are, as with any technical tools, we can generally say higher term time frame is a stronger analysis. I don't know. I'm not sure whether I agree with it so much, but many people say it. But the methods that I teach are primarily, I primarily use everything that I teach on lower term time frames because I'm a scalp trader. But I do use the same theory when I'm swing trading. So I swing trade, I position trade, I hold some positions months, never touch them, never look at them. But the tools that essentially I find my entries of it are, I use the same tools when I'm looking at a 1 minute time frame and when I'm looking at a 1 week time frame. So whether I'm holding that position for 5 minutes or I'm holding it for 5 months, I will use the same tools to identify my entries. So it's going to be used on any time frame. Okay, as with everything that I teach, it can be used on any time frame. It's the theory that's important. And one last thing that I have to show you here. Can't remember what I was what was I going to say on this one. I was going to show you here that we on this one we didn't take the highs. Okay, so this is an example of on this candle to this candle. So from here to here, you did not take the high. Okay, so this was originally not taking the highs with bearish CVD divergences, higher high on CVD, lower high on price. But then you do take the high. So you do take this high, and this is a swing failure pattern example. We take the high of this. Okay, so we take the high, but you see how the high was broken on very low volume. You have the volume coming into the level high. You actually take the high on extremely low volume, so in a decrease in volume, a decrease in delta. The following candle was an increase in volume and an increase in negative delta. This is screaming at you. Swing failure pattern, especially. What else could we be looking at? Open interest. Of course, we could be saying, did we take this high on a decrease in net longs and an increase in net shorts? If that's the case, likely a swing failure. Then confirmation really here is the high sell-off. Okay, the confirmation is really screaming at you. You got to short the next rise because we have approached the high on high volume. We then broke the high on weak volume, weak delta. We then, the following candle, sell off on high volume sell-off with a high negative delta. Why would you not be looking to short with stop loss above that high that was formed? That's a swing failure pattern, isn't it? So then we're looking, obviously, for price breaking down, and you can see here price does break down. So that's like a heads up as well that we could be looking at with looking at our delta, looking at the highs being breached on low delta, low delta, low volume on taking the highs. The run into the highs was on high volume, high delta, but that's not enough for the follow through. And then essentially you get the sell off on higher volume, higher delta. This is screaming at you short, stop loss above the high, get in on that trade. You even could have got in at a limit order and price, expect price to sell off. And the confirmation. Okay, so I've got this green line as the confirmation. That was the low that led you to the high. As you break through this low, short the next retrace, expect a sell off sort of thing. So yeah, there you go. That's CVD. That is CVD divergences, how I trade CVD divergences, and what they are essentially. So yeah, I'm sure we're going to have quite a few questions on this one. So I'll take your questions and we'll see how you've found this one. So let's see what we got here. So, do CVD divergences work the same as OBV, RSI, etc.? Can they also precede price action? Yes. Yes, they can. So, as given in some of those examples, you gotta look at the context. So you can see CVD leading price or delta leading price. Okay, and this is like naturally seen under our consolidation under resistance, where you're seeing it break up, price is not breaking up, and then price will follow. So obviously you will get divergences that are fake divergences, but again, you've got to look at how that level is approached. How do we deal with different CVD divergences from multiple exchanges? I would just say look at the exchange you're trading on. Okay, so if you're trading on BitMEX, focus on the BitMEX chart. Focus on the divergences on your BitMEX chart. It's going to be too confusing trying to look at every different exchange. Focus on the exchange you're trading on. Okay, that's the simplest answer I can give you. That's what I would do anyway. I primarily look at this only on BitMEX. So, yeah, it's very, very, very simple. Look at BitMEX like I do, or just focus on the exchange you're trading on. Yeah, I mean, if you trade on a random exchange I've never heard of, I'd be like, yeah, probably best to look at BitMEX. But, if you're on BitMEX Binance, it's going to be much of a muchness. I'd be happy to just look at BitMEX. Nelson, slide 9 out of 10. The swings do not match up. Is that not a requirement? Let me see what you mean. Slide 9 out of 10. The swings do not match up. Is that not a requirement? I'm not sure what you mean by the swings do not match up. Slide 9 out of 10. The swings do not... I have no idea what you mean. You're going to have to tell me that one again. I don't know what you mean. Slide 10. Would you use the term hidden divergences? No. So this was another question that I saw people posting about. So would I call this term hidden divergences? Is it the case or just divergences? Because on oscillator, this example would be called... I wouldn't say this is hidden divergences. I just would really simply say this is a divergence. I saw so many people in the group posting, we got hidden bullish divergences, we got hidden bearish divergences, we got bullish divergence. I'm not interested in calling this hidden divergence, bullish divergence, X, Y, and Z. The only two divergences are that I trade are the two that I've shown you today. Whether there's 100 different other ones, I'm not interested. These are the only two that I trade, and this is what I refer to them as. I refer to this as bullish divergence, okay, where we make a higher low on price and a lower low on the oscillator. This for me is our CVD divergence. Forget about RSI divergences with our hidden and non-hidden divergences. That's irrelevant to what we're looking at on CVD. Totally different things. This is a bullish divergence, okay? This is a bearish divergence, period. There's no hidden magic, X, Y, and Z. These are the two divergences that we have on CVD that I trade. Not interested in anything else. These are the two that I am using daily and very well used. So yeah, that's what I'd say on that one. I'm not sure. Yeah, that's simply what I'd tell you. What time frame are you looking at mostly? Really hard to say. I mean, on the trading updates I give you, I obviously donate 1 hour divergences. So 1 hour, I would say probably I'm looking the most at 15-minute, 1 hour. I don't know, I look at everything. So I'm looking at this on all time frames. So I can't really say most. Maybe my most 15-minute chart. I don't know, 5, 15 or 1 hour are the three that I use a lot. So it's probably equal more or less between the three. Shouldn't we use the same starting point for the divergence? Oh, that's probably what you mean. Did I take a different starting point? Starting point? Oh, this is 9. Oh, sorry. Well, it would have been the same, okay? If I took it from this starting point to this low, it would have still been bullish divergence, wasn't it? So, you know, yes, I suppose, yeah, we would be looking at the same, but that's just for sake of showing you, like, if I was taking it from this high as well, we still got the exact same divergence, okay? Where this is a, sorry, I meant to do it like this, where this is still, from this one to this one, this is still a lower low on CVD and a higher low on price. So I see what the two people mentioning now is what I was on about. I guess, yes, you'd be obviously looking at this peak to this peak, but here I moved from this one to this one. It's exactly the same thing that we have here, though. So it really, I mean, doesn't make any difference. But I guess a small mistake on my side there. That yes, I should have moved this back to this peak. But we still have the exact same bullish divergences there. Let's see what else we have. Do you, even as price makes a lower high from the previous high and CVD makes high, do you need to wait for the candle close or a bullish and bearish candle appearing at the lower high? As price makes a lower high from previous high and CVD makes a higher high, so a bearish divergence, do you need to wait for a candle close or a bullish and bearish candle appearing at the higher low? So it's up to yourself, isn't it? So this is something that you can experiment with, okay? So again, like here in this example, so he's questioning, like, do you need to wait for confirmation? Essentially, your question is, do we need to wait for some form of confirmation? The answer is, you can get aggressive and enter your shorts straight away when these form. If the context, if everything is leaning up to a bearish context and then you see this on top of it, well then yeah, you can be aggressive on your short. You don't need to wait for like a bearish candle to follow. You know, you don't need to wait for that. But if you are inexperienced, if you are wanting an extra form of confirmation, if you just really simply don't feel, you know, you don't have the confidence of trading these, so to speak, at the moment, or anything like this, then the confirmation is either seeing a bearish break, okay, in forms of market structure, or seeing at the highs then that follow on of negative delta. And obviously the pros and cons, as with everything, think of it like this: the pros of shorting at the high is that you gain more money if you're correct. The con is that if you were incorrect, then you lose money. Whereas if you wait for confirmation, the pro, the advantage of waiting for confirmation is it's less likely that you get stopped. Okay, when we're aggressively shorting at the highs here, expecting a breakdown, yes, we're more likely to take a loss because we could be wrong. Whereas if we're right, we win more money. The advantage of confirmation is you make less money because the percentage move is different, it is less, but we're less likely to lose money because we've seen the confirmation of the breakdown. So pros and cons of confirmation are: pro of confirmation is you're more likely to have a higher win rate because you're waiting for the confirmation essentially, but you make less money. And the pro of being aggressive is you make more money, but you're more likely to have a worse win rate because you're going to take naturally probably more losses. So there's pros and cons of confirmation. I'm not telling you which one is best. I generally take the aggressive approach, but then I've been doing this nearly 10 years. So I mean, it's up to you which one you trade with. But it's just really, 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 really crucially important that we're not just looking at this alone, and we're looking at other technical tools. We're looking at the context. We're looking at how we're getting these confluences. Okay. I'll look at CVD at the end. So I post a chart in BTC charts. Let me see what you posted. Do those statistics in combination with that candle indicate limit shorts getting filled? So this is the one that had been posted. So do those statistics. So do these statistics, volume, delta, CVD. Do those statistics in combination with that candle, this candle, indicate limit shorts getting filled. 46 million in the candle and only 3.8 million market buys. Positive delta. So I guess here, so this is obviously yesterday's price action. I remember this one. I remember this one really well. I mean, it's. So this is the thing. You're on a 15. So this is what I would say that you need to do, because I cannot really just say, like, looking at this. What you're going to need to do is like zoom into this candle. So this is really simply what you're going to need to do to answer this question is zoom into this candle. Instead of having none, flip this over to delta, zoom into the candle, see where the volume is actually within this candle. Is all of that volume coming at lows? Is all that volume coming at the highs? You could then also look at like CVD on like a 5-minute chart. Did you have a CVD divergence between this high and this high on like a 5-minute chart? Here you're on the 15-minute chart. I would be looking at things like this. I would zoom into this candle and see the footprint statistics of the price within the wick. Where's the volume actually come in? Has it come in at the high? Has it come in at the low? Where's the volume coming on this candle? Do you have CVD divergence between this high and this high? That's what I would look at to determine. I mean, in hindsight, yeah, we can say it was fairly obvious that you had someone holding it down. I'd imagine anyway, you had someone holding it down with limit orders, or alternatively, this was, we could have had a lot of buys at the low, but then it's pushed up here and you had really aggressive selling is what could also be another possibility, that you had really aggressive selling of the highs. So you've had an attempt to push up price higher, which was aggressively rejected, and then that is going to give you no confidence as a bull. If you get an attempt which is aggressively sold off, you're not going to think, oh, I'm going to buy here and we'll go again. You're going to think, well, that's a really big rejection. I'm going to hold off from buying here. And we all know what happened. Price dropped pretty heavily. So that's what I would say to you, what you'd need to look at. Look locally, then so zoom in. Firstly, zoom in at this candle, see the statistics. Secondly, see if you had the CVD divergences more locally. What is the importance of zooming in, and also why do you switch to the lower term timeframes? Well, I zoom into the lower term timeframes because I am a lower term timeframe trader. So like I would zoom into these lower term timeframes to like see action that's going on there. So that's why I zoom into the lower term timeframes, because it would make no sense if I'm trading a 5-minute chart not to zoom in, I suppose. And what is the importance of zooming into the candle? So the importance of zooming into the candle is essentially that we can see like the statistics of what's actually happening within that candle. You're better off to have the data than not to have the data, essentially. Would you see more CVD divergences in accumulation / distribution range? Possibly. I wouldn't say there's a correlation between the two and an overall structure. I would say it's unlikely to actually. I think you're unlikely to see it, because if you're in a distribution range, let's say, it would be really weird to like approach highs really aggressive buying. You're more likely to see like heavy selling in a distribution range, aren't you, rather than people aggressively buying in a distribution range. So I would say would be unlikely to see CVD divergences within a distribution or accumulation range. Because generally, if it's accumulation, we're seeing more predominant buying, and if it's distribution, we're seeing more predominant selling. So it'd be weird to see people who are aggressively buying in a distribution. Obviously, it can happen, but I guess that's the way I would envision it. It'd be a bit more unusual to see that. Could delta lead prices? Yes, as I've gone through that as well. So yes, delta can lead. Delta can lead 100%, and I think I've explained that. In like this example, that here we saw it leading. And we broke up. What else do we have here? You don't like divergences from candles with quick wicks. You prefer a build up. Is that also valid with RSI and OBV? You all know that I hardly trade RSI. I rarely look at RSI. I think you could all just delete RSI and you wouldn't lose a second in a trade. But yeah, I suppose with RSI as well, if I was looking at it, I'd want to see a build up as well. Yeah, it would make sense to also see a build up. And OBV divergence is not as important with OBV, so you can just see the initial injections. But yeah, overall, with all of these sort of divergences in general, you wouldn't really want to just see a quick wick, would you? Okay, and especially our RSI, like the RSI is calculated from the close, so a quick wick would make no sense to trade from because it would be invalid. It's calculated from the closes. So I guess yeah, with all of these, you want to see signs of a build up over time rather than just one quick wick. Is my answer to that one. Is the BTC example, I'll look at BTC in a second, would be safe to say delta leading price is very likely to happen in a range after a big drop and then in a range after a larger dump? Larger pump bearish. My answer to this is not necessarily. So we cannot just say that every time, every time there's a large drop, we're likely to break up out of that range, or every time there's a large pump, we're likely to fall down. That's definitely not a way that we could trade. Okay, so every time you see a big drop, there's no point in saying, right, we're going to break up from this if we get divergences. I mean, it's really hard to explain context, isn't it? It's probably the most difficult thing to explain because we're looking at so many different factors. But we cannot just have like black and I guess this is the thing with context. We can't have black and white rules because every single trade is under a different scenario. Every trade has its own context. So we cannot just have such black and white rules. And this is why, if you have a really good trading tool, your trading tool works 50% of the time, because maybe 50% of the time it's working is under the context of when it would work, and the 50% is when you're trading it incorrectly per se. So you cannot have black and white rules in trading, period, in my opinion. But yeah, I can't give a good answer to this one, if I'm honest, because I would say it's not going to be like this all the time. It's just... yeah, I wouldn't be able to say that, to be honest. Sorry, could the chart of the week setup have been considered bullish consolidation under resistance? I'll look at chart of the week at the end. Chart of the week at the end. Do you have any statistics? How many times to get through over after a CVD divergence? Seems to me that seems to me that it doesn't happen at all. Of how many times you get a throw over after a CVD divergence. So do you mean how many times we see something like... okay, so here we actually have a really big CVD divergence, don't we? So here we have, let me just hide the pointer controls. So here, what we can see on the Bitcoin chart at the moment is lower high, and this is breaking up for higher highs, okay? Especially if this can continue, so if we can do something like this, okay, so if we can do something like this, oops, I wanted to select the other tool. So if we can see like now in another regression of like this, okay, or this builds around here, this is going to be giving us really strong bearish divergences, isn't it? Because we'll see big term time frame bearish divergences, and locally we'll get them as well. So that's what one would like to see. It's already starting to happen here, okay. But I'm not sure what you mean by how many times you get an overthrow after CVD. Maybe I'm being really dumb. How many times do you get an overthrow after CVD divergence? I think then that you mean how many times do we see like this, a CVD divergence form, which then gets a swing failure and then dump? Is that what you mean? If you want to just confirm. I think that's what you mean. Like how many times do we get a range that then swing failures and then dump? I mean, I don't actually, that's not something I record. So I'm going to be honest. I've not recorded how many times do we get a swing failure pattern of a CVD divergence. So I can honestly tell you, I've not got any statistics on that, but maybe that's something that you would want to build yourself. But I don't have the data to tell you that, if that's what you're after. I think that's what you mean by your question. I'm pretty sure that's what you mean, but yeah, I don't have that statistics to tell you, unfortunately. I've never ever recorded that. Cool, so that's all the questions that I have there. Oh no, we got one more. I have noticed that when studying price action with cumulative volume delta, that upon the break of the zero line, we get a potential good trade, long or short. I posted an example in Discord. Let's see. Oh. So the question is that upon a break of the zero line, we get a potential good long / short. Okay, good longs. So let me just read this again. So upon the break of the zero line, we get a potential good trade long / short. So 0 break retest. I mean, I wouldn't be able to tell you this if I'm honest with you, because this is not something that I trade off of. So I've never traded this off of a zero line like this and looking for retests of the zero line. I would be very interested if you wanted to like build up statistics, but it's like the overthrow. I've never built statistics of the overthrow. And I've never even looked at it as it in this perspective of looking at the zero line on CVD and looking at retests of it. So this is, unfortunately, I cannot help you in this because I've never tried it myself. If I don't know something, I'll happily say it, and I've never ever traded it like this. So I unfortunately cannot really tell you whether this is a good or bad method because I've never done it. So sorry there, Igor, but I'll be honest with you, I've never done that. So for example, if on the high we have positive delta, footprint chart, so for example, if on the for example, we have positive delta on the footprint chart, 30 million. So so you're looking at a candle. There's 60 million volume in the candle and 30 million positive delta. On that candle, we have negative 3 million at highs. So you're saying if you have a 60 million volume candle and there's 30 million delta, positive delta, and 3 million negative at the highs, well, I would say that's not really a lot. I mean, it's so hard for these type of questions. I'm not going to lie. I struggle with these type of questions because, I mean, 3 million in the context. I mean, what's the context of how if we approach this level? What's the average volume in every candle? Is this suddenly a really low volume? Is this suddenly a really high volume? I mean, it's really difficult for me to give any type of answer on this because it's just such like it's really arbitrary question, I suppose, of like without being able to see, without being able to say, is 60 million massively high suddenly? Is this really low? Is this average? I mean, 3 million. I mean, just simply from this, if I saw a volume with 60 million, the positive delta had 30 million, there was 3 million at the highs, I would say that's not really a lot. And so I wouldn't say that there's any, 3 million, you have some 3 million at the highs, but that's not really enough to be trapped short. If that's all it is 3 million at the highs and the rest is buys, then I would say that that's not a lot to be trapped. When you trade waiting for confirmation, do you usually wait for a retracement? As it has taken a low, it will probably bounce a little bit. When you trade waiting for confirmation. So I suppose that this is the thing. Okay, so I'm never ever trading off a CVD alone. I think that this is really important. Everyone understands. I'm never ever just trading off of this alone. When I post in the group, for example, bearish or bullish CVD divergences and they play out, I'm not just saying that this is played out because of the CVD. I am looking at much other things than just this one thing. So this is massively important that you all fully understand this. That I am not just looking at this when I say, oh, there's CVD divergences here. I've done more technical analysis to give me the reasonings of why I think it's going to play out, sort of thing. So, sometime, I guess if like my findings are coming together and I'm ready to short or buy this level, then I won't need to wait for the confirmation of a retrace because I'll happily have bids preset waiting if I have the confidence there. But yeah, obviously if we get that small retracement, then that only adds to the thesis that I had, for example, that would break down. And you take us through your thought process of CVD relative to the current price. Yeah, I'll look at this at the end. When you short on BitMEX with a limit, you said if price moves against you that you get out with a limit, then it's not a losing trade because you get paid on fees. Yeah, absolutely correct. Let's say that you short 9,000 and you close at $9,005, so a minuscule loss of maybe like 0.1%, let's just say. But then if your limit order rebates are higher than the loss that you're taking, then yeah, you take a loss on the trade, but you make money because you got paid in limit order fees. Okay, the market pays you to provide liquidity, so even if you take a small loss, then actually you could have made money on that trade via the fees, the money that you're getting paid from providing liquidity. Cool, so that is all the questions done. Those are the questions done. There was quite a lot of questions that I was kind of envisaging that we'd get a lot of questions, but those are those questions done. I'm not going to lie, I need to start bringing 2 pints of water to the stream, and I also need to fix these lights because the heat, I'm sweating. I'm not sure if you can see, but I'm literally sweating from the heat that is being produced by these lights, and these are expensive lights. But yeah, I am literally getting a sweat here. So yeah, as I was going to say, yeah, those are the questions done. I will cover Bitcoin briefly here. I'm gonna cover Bitcoin briefly. I'm not gonna go in depth for you, just so you're aware. But I'll do a quick overview of Bitcoin for you all. But I'll probably do a live stream for you tomorrow morning. Rather than going in depth now, I'll just give you a 15-minute live stream tomorrow. Really simply. What do we have here? Yes, we do. We saw it. we have bearish divergences here. So whether these play out, I guess we have important support around 9,000. Because this move up was so quick, it hasn't built any support. So whether we come back down really quick, yeah, it's possible. But we have really important support, 9,065. Okay, so 9,065, really important support. Really important resistance. The monthly, I think you're in a bit of no man's land at the moment. This is for me neither a good long, neither a good short. I wouldn't be longing here. I wouldn't be opening a new short here. I would really simply not open anything here. So my analysis is really, I personally wouldn't do anything here. As you all know, I've been telling you all day that I'm not in a position at the moment. I was in a long from down here. I closed my long up at the highs, and I'm in no position. I'm not in a long or a short. I guess for me, a short would be if we actually break back down into this channel, or alternatively, we come back up and we swing further some highs, specifically these highs, then yeah, I get into a short. Where would I look for a long? Well, if we bounce off of this and hold it, well, then I have more defined risk. Okay, well, I've been using that as my stop loss. I'm not interested in taking a position here. It's I guess if I wanted to do anything, I'd take a short, to be honest, because I probably would. But I mean, I'm not shorting this. I haven't shorted it all day. That's kind of my perspective on this. We obviously have this really nice Gartley, which is giving us potential targets of around 9,500, really all the way up to 9,700. So we have potential targets of 9,500, 9,700 on the Gartley, which would obviously then lead to a decrease in price. But yeah, I'm not interested in taking a position here, if I'm honest. I'll look for a short higher up. Okay, or alternatively, I'll look for weakness and short, or I'll look for a long if we hold this and if we hold it essentially. But yeah, there's nothing here for me to take an aggressive entry. I'm comfortable shorting lower down. I'm comfortable shorting higher up. I'm comfortable longing on a retest. I'm not comfortable or in any need to take a position where price is now. So it's as simple as that, if I'm honest with you. I'm in no position. I was in that, as you all know, I was showing you my orders. I was in a position this morning from 8,014, and that was really simply, we broke this. Okay, this is why I was in the long. We obviously had this bit of initially support off the middle of the channel, broken, resistance off the middle of the channel, broken. We back tested it really easily. Support, resistance, back into support. I was in a long, and price broke up. Really simple, if I'm honest. It was an easy long trade. But yeah, I closed it out at the highs. Can we still move up higher? Yeah, and I'll look to get into a long if we get a back test. If not, I'll just ride up spot and not shorts, to be honest with you. So that's my plan on Bitcoin. Very easy. I hope that you have enjoyed this video. I need to sort these lights because I'm dying of a sweat. Hope you've enjoyed this one. Any other questions that you may have, then come across to Discord. I'll answer your questions in Discord. I'm going to go and have an ice cream. It helps my throat. Have an ice cream after every live stream now. It's a godsend. And wow, Engine Coin, going for it. I hope that you've enjoyed this one. Thank you everybody so much, and I'll catch you in next week's stream. Cheers, thank you, and have a good one. Thank you. Bye bye.